Hi, this is Juliet Young Orfiano. Welcome to my video. If this is your first time on my channel, please like, share, and subscribe so I can notify you if I have a new video. This is the continuation of part 16 about inventories. I discussed in part 16 about the inventory estimation methods, gross profit method. Just click above or the link below this video to watch part 16. In this video, I am going to discuss about the inventory estimation method, retail inventory method. Retail inventory method. The retail method is often used in the retail industry for measuring inventories of large numbers of rapidly changing items with similar margins for which it is impracticable to use other costing methods. The cost of the inventory is determined by reducing the sales value of the inventory by the appropriate percentage gross margin. The percentage used takes into consideration inventory that has been marked down to below its original selling price. An average percentage for each retail department is often used. PAS or IAS number 2, inventories, paragraph number 22. The retail inventory method requires the maintenance of records of purchases at both cost and selling price. A ratio of cost to retail is calculated and applied to the ending inventory at retail to compute the approximate cost. When using the retail inventory method, the appropriate treatments for freight, discounts, returns and allowances, and other relevant items are as follows. Letter A, freight in is an additional to purchases at cost. Letter B, purchase discounts and purchase allowances are deductions from purchases at cost only. Letter C, purchase returns are deducted from the cost and retail amounts of purchases. Letter D, sales returns are deducted from retail sales. Letter E, sales discounts and sales allowances are not deducted from retail sales. Letter F, departmental transfer in or debit is an addition to both cost and retail amount of purchases. Letter G, departmental transfer out credit is a deduction from both cost and retail amounts of purchases. Letter H, normal losses, shortage, shrinkage are deducted from the goods available for sale at retail after computing the cost ratio. Letter I, abnormal losses are deducted from both costs and retail amounts of purchases before computing the cost ratio. Letter J, discounts to employees and favored customers are deducted from the goods available for sale at retail after computing the cost ratio. In effect, this is an addition to sales. The original selling prices of goods may be modified as a result of some market and economic forces. Thus, the following terms. Original retail, the first selling price at which goods are offered for sale. Markup or additional markup, an increase in the selling price over the original retail price. Markdown, decrease in the selling price below the original retail price. Markup cancellation, a decrease in the selling price which does not bring the new selling price below the original retail. Markdown cancellation, an increase in the selling price which does not bring the new selling price above the original retail price. Net markup, markup less markup cancellation. Net markdown, markdown less markdown cancellation. Illustration of markups and markdowns. Original cost, 100 pesos. Original selling price, 50 mark on is 150. Increase in selling price, additional markup is 50. Original selling price plus additional markup, 200 pesos. Decrease in selling price, markup cancellation, 25 pesos. Original selling price plus net markup, 175 pesos. Decrease in selling price consists of 25 pesos markup cancellation and 25 pesos markdown is 50 pesos. Original selling price less markdown is 125 pesos. Increase in selling price, markdown cancellation, 10 pesos. Original selling price less net markdown is 135 pesos. Increase in selling price consists of a 15 pesos markdown cancellation and a 25 pesos markup, 40 pesos. Original selling price plus net markup is 175 pesos. Under PAS or IAS number 2, both net markups and net markdowns as well as the beginning inventory are included in the computation of the cost percentage that is applied to the retail ending inventory. This approximated average cost of the inventory is then compared with the net realizable value, the lower between the costs approximating the result of the average cost method, and the net realizable value is the inventory amount that will be reported on the statement of financial position. The following computations illustrate the use of the retail inventory method. Approximating average cost. Beginning inventory cost is 70,000 pesos, retail 126,000 pesos. Purchases cost 340,000 pesos, retail 438,000 pesos. Purchase returns cost 20,000 pesos, retail 24,000 pesos. Purchase allowances cost 2,000 pesos. Purchase discounts cost 1,200 pesos. Freight in cost 4,000 pesos. Additional markups net of cancellations, retail 24,000 pesos. Markdowns net of cancellations, retail 10,000 pesos. Abnormal losses cost 18,000 pesos, retail 22,000 pesos. Departmental transfers out cost 8,800 pesos, retail 12,000 pesos. Total of cost 294,000 pesos, total of retail 394,000 pesos. Goods available for sale cost 364,000 pesos, retail 520,000 pesos. Goods available for sale at cost 364,000 pesos is equals to 70% over goods available for sale at retail 520,000 pesos. Deduct sales 380,000 pesos, sales returns 15,000 pesos, employees discounts 1,500 pesos, normal losses 2,500 pesos, total of 369,000 pesos. Ending inventory at retail 151,000 pesos. Ending inventory at retail times percentage 151,000 times 70% is 105,700 pesos. Both net markups and net markdowns as well as the beginning inventory are included in the computation of the cost percentage that is applied to the retail ending inventory. This approximated average cost of the inventory is then compared with the net realizable value. The lower between the costs, approximating the result of the average cost method, and the net realizable value is the inventory amount that will be reported on the statement of financial position. When the retail method assumes a FIFO cost flow, the cost and the retail value of the beginning inventory are excluded from the cost ratio computation. The cost percentage that will be developed is the ratio of the current cost of purchases to the current retail prices of these purchases, adjusted for net markups and net markdowns. The approximated cost of the ending inventory is therefore based on the ratio of cost to retail on current period purchases only. In the previous example, the FIFO cost retail ratio is 74.62%, which is arrived at by dividing the 294,000 pesos by 394,000 pesos. The cost of the ending inventory using the first in first out method is therefore 112,676 pesos, which is 151,000 times 74.62%. When the net markdowns are excluded from the cost ratio computation, the cost to retail ratio will be slightly decreased, giving an ending inventory figure that directly approximates the lower of cost and net realizable value. Under this conventional retail method, the net markdown is an adjustment to sales. The cost ratio is 68.68%, which is 364,000 pesos divided by 530,000 pesos. The total amount to be deducted from 530,000 pesos would be 379,000 pesos, inclusive of net markdown of 10,000 pesos. Thus, the ending inventory at retail is also 151,000 pesos, while inventory at cost is estimated at 103,707 pesos, which is 151,000 times 68.68%. The amount of the ending inventory at retail would be the same in all computations. However, the estimated cost of the ending inventory would vary depending on the cost ratio applied. The method prescribed by pass number 2 is the method that considers the next markdowns in the computation of the cost ratio, eliminating in effect the use of the conventional retail. Thank you for watching my video. I hope you learned something from this video. I did part 18 and continuation of this video wherein I discuss in part 18 about the effects of inventory error. Just click above or the link below this video to watch part 18. Don't forget to like, share, and subscribe on my channel so I can notify you if I have a new video. Once again, this is Juliet Orfiano. See you on my next video.